A slick online advertisement flashes across your screen, promising a revolutionary AI system that predicts market movements with an astonishing 90% accuracy. It beckons you toward a future free from financial uncertainty, where every trade is a guaranteed win and wealth accumulation is as simple as clicking a button. This tantalizing vision stands in stark contrast to the messy reality of financial markets, where even seasoned human experts struggle with uncertainty and frequent failure. This gap forces a critical question. Is AI stock prediction the breakthrough truth we have been waiting for, or merely the latest iteration of market hype? In simple terms, AI stock prediction uses powerful programs to analyze vast amounts of data and identify patterns that might suggest future price movements. These systems operate beyond human limits, processing more information more quickly than any team of analysts ever could. Within the noise of global markets lie subtle, recurring signals. Can an unemotional, tireless AI detect them and translate them into precise buy or sell recommendations? To understand what AI for stocks really is, we need to look under the hood at the different types of models that power these systems. They vary greatly in complexity and approach. First, rule-based systems, explicit human-written instructions. If price crosses above the 50-day average and volume is 20% higher, then issue a buy signal. Transparent and simple, but rigid. Next, classical machine learning. These models learn from data, past prices, volumes, earnings, and outcomes. Linear regression, decision trees, support vector machines, finding statistical relationships. They learn which factors are linked to up or down moves. Building rules based on probabilities. Most hyped, deep learning, multi-layer neural nets that spot subtle, abstract patterns. An AI is a voracious data-eating machine. Its power depends on the quality and breadth of its inputs. Historical market data, decades of prices, opens and closes, daily highs and lows, and volume. AI scans history at scale, finding patterns, momentum, and volatility trends. Market psychology often leaves repeating footprints. Fundamentals, earnings, revenue growth, margins, debt, cash flows, across thousands of companies. AI learns traits of businesses that tend to outperform. Unstructured text, scanned with NLP to gauge sentiment in real time. Alternative data offers early glimpses of real activity. More data can mean more noise. AI can mistake randomness for signal. A surge in mentions might be a meme, misleading the model. Effective systems require cleaning, curation, and proper weighting. Fuel the engine with quality, not digital garbage. The promise is real, but only as good as the data behind it. Bold accuracy claims are seductive, but accuracy in doing what exactly? Direction over a day without magnitude is barely better than a coin flip. Magnitude matters. Most stats come from backtests, performance on historical data. Necessary, but perilous. Overfitting memorizes the past instead of learning principles. Overfit models fail spectacularly in the wild. The future never perfectly replicates the past. Backtests often ignore costs. Fees and slippage can erode or erase paper profits. Real-world accuracy is almost always lower. Studies show small, fragile edges, if any, before costs. Success comes from data, speed, and risk, not one magic algorithm. Near-certainty claims deserve extreme skepticism. The risks are profound, starting with regime change. Patterns that worked can become counterproductive overnight. Unseen shocks break models trained on stability. Deep models can be opaque, hard to explain, harder to fix. Blind trust plus bad data equals catastrophic decisions. Edges vanish as others discover and crowd them. Data quality is foundational. What do experts think? Moving beyond marketing. Skeptics say prices reflect information. Consistent prediction is impossible. Success can be luck, data mining bias, or hidden risk. Few beat low-cost indexes after fees. Optimists find small, domain-specific advantages, probabilistic, not prophetic. The pragmatic middle, AI augments humans, manages risk, and generates ideas. Consider two simplified case studies. A fund targets post-earnings reactions in mid-cap retail. It learns linguistic cues and microstructure signals. Rapid execution with strict risk limits. About 58% correct, far from 90, but enough with discipline to outperform after costs. A startup predicts next week S&P 500 direction. Backtests look phenomenal. For 6 months, it works. Then a shock not in training data hits. The model misreads fear as a dip. Losses cascade. A stellar backtest precedes real-world failure. Without interpretability and risk control, adaptation lags. Realistic success is narrow and risk-managed. Failure is broad ambition with weak guardrails. Practical advice for the modern investor. Demand transparent, verifiable live performance across regimes. Do not be swayed by hypothetical backtests. Seek third-party verification. Investigate all costs, subscriptions, commissions, taxes, slippage. Small edges are fragile. True performance is what stays in your account. Never go all in. Treat AI as one component of diversification. Start small to evaluate real-world performance. Use your own risk limits. Define and stick to a maximum loss. Have a fail-safe for model malfunction. AI is a tool, not an oracle. Best used alongside human judgment. Use AI for screening, sentiment, and risk flags, then verify. Be ready to override when fundamentals contradict. Harness its power while mitigating risks. So what is truth and what is hype? Truth. AI is a powerful evolution in financial analysis. Fast, scalable, pattern finding. In data-rich niches, it provides real, measurable value. Hype guarantees extreme accuracy and black box faith. Hype ignores overfitting, costs, and regime change. Markets are adaptive and non-stationary, no crystal ball. Reality. AI augments humans but should not replace them. Edges are small and fleeting after costs. Greatest value, idea generation, screening, sentiment, and risk identification. Pair AI with timeless principles. Diversify, think long-term, manage risk. Final verdict, partial truth wrapped in hype. AI works in specific contexts, for small edges with oversight. Use AI as a navigator's compass. Valuable, but it still needs a skilled hand at the helm.